Next, we're going to look at a replacement analysis problem. This is when we're replacing an existing piece of equipment with a new piece of equipment. Acme Incorporated owns a CNC machine that it is considering replacing. Its current market value is $25,000 for the existing machine, but it can be productively used for 3 more years, at which time its market value will be zero. Operating and maintenance expenses on the old machine are $50,000 per year. Acme can purchase a new CNC machine with the same functionality as the current machine for $90,000. In 3 years, the market value of the new machine is estimated to be $45,000. Annual operating and maintenance costs will be $35,000 per year. Depreciation is straight line over 3 years. Should the company replace the old CNC machine using a weighted average cost of capital of 15%, a marginal tax rate of 25%, and a study period of 3 years? Well, the initial outlay, if we purchase the new machine, will be $90,000, plus the after-tax sales of the old machine, which will be $25,000 times 1 minus the tax rate of 25%, so that they would realize a return of $18,750 on the old machine sale. So the net initial outlay would be a negative $71,250. The operating cash flows, the firm would save $15,000 a year for 3 years in earnings before interest, taxes, depreciation, and amortization. Depreciation would increase by $30,000 a year because of the purchase of the new machine. So the earnings before interest and taxes change would be a negative $15,000, which means we could use that money to shield taxation in other parts of the corporation. So that means we would save about $37.50 per year on taxes. The EBIT change, when we do the math, would be a minus $11,250. Adding back depreciation would give us $18,750 per year. The terminal cash flow would be $45,000 times 1 minus 25% for $33,750. So we have an initial outlay of a negative $71,250 and operating cash flows of $18,750 for 3 years, and then a terminal cash flow of $33,750. Meaning that our project free cash flows are a negative $71,250, $18,750 for years 1 and 2, and $52,500 for year 3. Plugging these into our cash flow registers and then computing NPV ends up with an NPV of a negative $6,248.36. The project will decrease the value of the firm by $6,248.36.